Okay guys, I was watching in the Discord a discussion about madness, taking profits, etc, etc, etc. And I didn't want to chime in, but what I'll say is just be respectful of each other. You know, we all have a different opinion and we all have different viewpoints. Trading is not about being right. It's about being right at the right time and using the right tool at the right time. Just like any builder, you have to develop a skill set and know what tool to use when. Now, madness is not a get out of jail free card. It's not there to generate profits. It's there to manage a trade, period. You should already know what your stop is, know what your primary target is before you go to market. If you don't know what these things are, you need to go back to the drawing board and start reassessing. So let's have a little look at something. So what we can see here is my favorite quote: know thyself. That's your first building block for your trade. Are you nervous? If you are, you want to be in and out of the markets quick. Are you patient? You can hold the trade a long time. This helps you with risk reward. I hate that term risk reward. I'm going to ban it from the group. It's absolute horseshit. I've been in business 25 years and I'm telling you straight, it's just a sales pitch. All it is just you're shit at your job, but you're going to get paid. Think of it this way. You put 1 unit into the market to gain 3 units. Oh no, Stormtrooper's dead. To gain 3 units, where do you think the market's going to go to first? Is it going to go straight to here? Or does it have more chance to go there? Well, it's 3 times more likely to stop you out than hit that target. 3 times. That's why win rates are so low and why they talk about this fabled bollocks. Right? On paper it looks brilliant. It's like moving average cross systems. Simplest in the world. On paper they look brilliant. I get in here and I hold it all the way up to there. Very rarely you can do that. Why? Know thyself. Your human nature takes over. You can't cope with it. So you need mechanisms to help you. So work on principles. Let's get rid of this. Same principle. Point A to point B are equal. You are 50% hit rate. Higher than any of the gurus will tell you about. Higher. So what's your edge? It's your direction. So that's why I pay a lot of emphasis on levels. Get my dominant direction in place. Then I think about going into market. I don't do it the other way around. I have all my ducks in alignment before I even think about opening a chart. Most of you don't. You think I'm trying to get 10 pips. I'm trying to get this right. I want to be in the market. You've already failed. So give up. Go home. Go work McDonald's. Do something else. I don't give a fuck. I'm sick of the way I'm spoken to. Apply common sense. Right. Now you've got this in your head. Let's define stop. What is it? What is it essentially trying to achieve? Drop it in the comments. Let's have a little chat. Pause the video. Think about this. well, it's 1 unit, and that's what I'm willing to put in the market. 2% of market. Who gives a shit? What's 2% of 100 quid? £2. So you put £2 in the market to try and get 10. Why? Because 10 seems pretty good. It is on 100 quid. But you start putting 2% into big figures, suddenly that money amount looks freaking huge. And you can't cope with it. Why? Know thyself. You've got to know what you're up to. So really, what is the stop? It's not 2%, it's not 1%, it's not 10%. It's what you can cope with. What you are willing to put on the line. Now, if you're risking your whole account, or half your account, etc., fine. As long as you can deal with it, you know. But if you can't deal with it, you have to dial it down. And how do you dial it down? Well, it ain't with percentage trading. It's with money trading. Now, that's going to perplex you. But everybody said I had to put 2% in. And if I put 2% in, I drive a green Lamborghini. Well, tough fucking shit. You're not driving a green Lamborghini. In fact, I've got one, I'll show you.
Who'd be stupid enough to do that?
Justify, stupid.
That's as close as you're going to get. And this, little Rory, little friend to you, it's got my name on it. See that? Yeah. Little salute to you, kid. Keep that over there with all the rest of my gifts. Actually, I'll pick the Stormtrooper up while he's there. While I'm there, because everything I do is live, boys and girls. Everything. I don't believe in sort of anything else. When you see me trade, it's live. It's never retrospective. There we go. Wake up, you little git. Look, sir, droid. Boy Wonder gave me that. Well done. Hope you're doing well, kid. Catch up with you soon. Anyway. Money trading. Dreaming. That's what you're doing. Dreaming. Go back to money. Right. You got £1,000 account. And you say 2%. What's that? Means knack all. Nothing. Right. Now let's look at it a different way. How much of that are you prepared to put on the line? Or how much do you feel comfortable with? 50 quid? 50 quid's not going to dent that much. Not really. 100 quid's not really going to dent it that much. Not in the grand scheme of things. But if you've got your head screwed on, and you've got your direction in place, you've mapped your chart out, you know exactly where you're going, suddenly you start thinking, 50 quid's not bad, you know, 100 quid, it's not bad. Once you go beyond that, obviously 125, 150, it's a bit keen, it's a bit rough. Okay. So where do you feel comfortable? I feel comfortable about 100 quid. All right, 100 quid. Right. So I put £100 on the table. That's my day allowance. Day. Remember that. Day. Alright. Now that could even be for a week. I work my account on a weekly allowance of 10%, which works out 2% a day, which then breaks it down into trades. Trade twice a day, it's 1% a trade. Difference is, it's a big account. I couldn't do it with 1,000 quid. I've got to look at it in a different way. So I look at it like this. 100 quid a day. Don't want to spend 100 quid on one trade. Fuck no. But if you're listening to the guru, fucking dickheads, they'll tell you it's 2% risk per trade. What if you trade 5 times a day? Equals that. I see people trading 10 and 20 times a day. Fucking morons. Damn sight more than what that is. So that actually puts a limit on what I'm doing on the day. Makes me understand what I'm actually playing with. Why? know thyself. I know what my tolerances are. Know exactly what they are. So, where am I going with this one? Right. I know if I go into a trade and I go flat out on it, flat out, it's 100 quid. Right. So what's my next sort of looking point at a chart? Well, it's the bid. I've already worked out what the stop is. I can't exceed 100 quid, £100. So I now need to look at the bid. Right, okay. I'm going in at £10 a point. Why? Because they say whack it in, you'll be fine. Where's your 2% in that, boys and girls? Fecking nowhere, because you've got no clue what you're doing. Moron. Right, I'm going in at £10 a point. So what does that mean? I've got 10 pips to play with. You do that on the DAX, suicide. Kill you. So you've already told yourself that's wrong. Right, okay. I'll half it. I'll go in at a fiver. Right, okay. I can do 20 pips. It's 20 pips of safe stop in a vicious market. It's tight. You know, on the DAX it'll do that in 5-10 minutes. So you've got to actually time your market perfect. Well, you time the market perfect. Don't need to listen to this video because you obviously know what you're doing. Clearly. Too much. Why? Because you've got all your eggs in one basket. Right. What if I do a pound? Well, if I do a pound, I can do 100 pips. Stops miles away. Brilliant. Am I going to let it get there? Not on your Nelly. No way. But I've got time to work it out. I can see the market is against me. I'll just kill it. And if I kill it, fine. And if I kill it at 50, it's a damn sight better than trying to work that out. If I kill it at 50, it's a damn sight better than working that out. If I kill it at 50, say that 3 times, bum, 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 I've got time to work that out. So working in money and then applying the position size to that helps you stretch out your stop, helps you understand the market structure. Why? Because I'm not trying to time the sudden thing. I'm not trying to brutalise it. And why is that? Because none of us know where the market's going. All we have is an echo of the past for a vision of the future. That's all we've got. What's that echo of the past? Levels. And what are levels? Key turning points. That's it. The market operates through impulse drives and pullbacks. That's it. Even when it's in a range, it's still an impulse drive and a pullback, but they're on the next frame down. So if you're looking at a daily range, you look at 4 hour or an hour and you'll see the impulse drive and the pullbacks. If you're looking at an hourly chart, similar principle. You look down at a 15 or a 5 and you get to understand what's going on. What do you use for that? Fib. And what's that? Well, you need a clear bottom and a clear top. Put the fib in. That's it. You can't do it unless you've got 2 fixed points. You can also use Elliott waves. I don't like Elliott waves, but you can use the same principle. To drive up, it's a pullback to the 38 or the 50 of that initial impulse. Right. An Elliott wave will run between 3 and 7 waves. So if you're at the 3rd wave and there's another one coming, you know it might roughly run up to 5 waves. Up, back, up. Simple. If it's at the top of 5 and you see it's weak, because you can see it on a Bollinger Band, an RSI, stochastic, CCI, whatever the hell it is you're looking at, You see it's at the top of the range. Oh, well, it might be actually running out of steam now. I'm going to look for the impulse drive and a break and an extension to the next level below. You're looking at market structure, you're building up. And where did it all start at? Here. You knew what your allowances are for the day. You've planned it all out. Right. I know what 100 quid is. I know how much I can spend. Now I need to make that make me money. Right. ROI. Next question I'm asked. Right. Okay. You go to your bank, put 100 quid in. There's me deposit. We've got a high risk fund there, Scruff. You might lose a bit, but you might gain a bit. Are you happy with that? Yeah, I'll go with that. What's my rate of return? Well, the high rate's about 9%. What's the low rate? About 2%. Do fancy 2%. Fucking a lot of hard work. Fucking hell, put it in a slot machine for 2%. I put it on the high rate. Brilliant. So I've got it on the high rate. So I know I can lose it. But I'm getting 9% back. But you don't think about that in the markets, do you? No. You think, oh, I've got to put 1 unit in. I'll put my 100 quid in. And I'm going to get 3 back. Right, well, there's your 3. How often does that happen? Not very often. Why? Because the market is more likely to hit the sodden stop. I've just told you that. Right. Minimum criteria, 10%. Right, so I'll make a tenner. Okay? What, you're putting 100 quid on to make a tenner? No, I'm not. I'm putting 100 quid on to carve multiple tenners. As the market is moving and impulsing back, impulse up, drive back, impulse up, drive back, I can capitalize on each one of those moves and maybe do it 3 or 4 times inside an Elliott wave of 7, if that makes sense. Or as the market is in motion, an Elliott wave can move to 9 actually, but you don't know it's an Elliott wave till you see it's an Elliott wave. You might actually be at the top because there's an argument to say, well, I'm looking at this, it looks like an Elliott wave, but then it's not, it's actually just a head and shoulders. So when you're looking at market structure and all of these patterns, they don't exist until they exist. And at that time, it's too late. So the only thing you've got on your side is a tool that can help you predict that. If you've got 2 fixed points. Back to fib. Right. Let's look at a fib. 0, 23, 38, 50, 61, 76, 100, 127, 161. 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 levels. 9. If I can get 10% between each one as it's moving, that will get me 90 quid. All right? I'd like to be more than that. But the principle is what I'm working at. I'm carving around the markets, using the market to my advantage. As it moves up, comes back, get 10%, leave a little bit on, let it run a bit more, maybe get more than 10%. But what I'm driving at is, I'm using that 100 quid as a baseline, as investment, not risk. I don't like risk. I think risk is a stupid term. Should risk nothing. You invest. And if you're right, you get a return. Now, if I get 10% back, brilliant. That's my minimum criteria. I actually want 100 and 150 back, but it's hard. So you work the market. So how else could you do this? Well, a very simple way. Right. Come back. Got 100 quid to play with. Right. I'm on a pound a point. Pound. Entry criteria 1. 0, 1. Going down to the fib. 100%. End point. Right. Do I have to stick with fibs? No. But what did I tell you about a fib? 2 fixed points. Now that can be 2 levels. It can be a high or low. It could even be top of a Bollinger Band, bottom of a Bollinger Band. Plenty of different ways you can work out 2 fixed points. Then you break it up like a ladder. Going down to your stop. You're laddering to the stop. So, what's this scenario telling you? It's 100 quid. I'm at £1 a point. £1 a point. Order, 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 order. What happens is, that can be 100 points away. Or 100 pips, whatever you want to say. Right? Really can. Just as easy figures. But if I'm going same size each time, well, that's a big stop. That's a little stop. It actually reduces in value as it goes down. All the way. So you're combining multiple trades in a ladder system and you build up 1, 2, 3, 4, maybe 5 positions. Why? Because I've just told you the market will push up, it'll impulse down, and then it'll push up again. That way, even getting in at the top of the market, you build your trade up, reducing the exposure as it goes down into the stop, but you're actually increasing your target running up. It's a very simple process. It's ladder trading. Now, you can madness in, hold the whole position up to a 127 expansion, which will give you a big payday, or you can use the ROI method and go, right, okay, let me just clean this down a second, boys and girls. Let me clean this down. So you got 1, 2, 3, 4, 5, 6, 7, 8, 9. So you've got a bunch of orders here. 1, 2, 3, 4, 5, 6, 7, 8. Out. Just call that the OT, the out. Right, what's happening now? All right, I get in here. Market moves down to there. Bollocks. It's gone against me. Right, put another order there. Okay, what happens then? Well, comes back up. Take your TP, close that. You've just made yourself some money. Reassess the chart. What's happening? Okay, I'm going back in here. Goes down. Put an order there. Goes down. Put an order here. Bollocks. What's going on now? Well, I've got my start point, which is there. That comes up. Take a TP. Put the order back, just in case it comes back down again. This order now takes over, comes back up to start. Take your TP, close the thing off. Why? I was sudden wrong. It went against me. So now I'm using the ladder to carve profit going back to where I started. It's a different way of doing it. Or you could actually do it that way on purpose and think, okay, I want the market to come down. It's easier to do it this way. Right? I want the market to come down to here. And I'm going to follow the candles. Brilliant. So this time you're letting the candles come down. So what you're doing is you put your order above a one and you trail it. Okay? comes down, this one comes down, this one moves up. But that didn't break that candle, so you just leave your order there. Eventually goes down, and then it comes back up, and the order you have there triggers. Brilliant. So what I'm going to do now is I'm going to target the ladder, the next phase up. And it's all broken up into pieces. Brilliant. Got that. Close it off. TP. Do it again. And you're using the ladder points all the time as structure points. It's just using maths to your equation. Maybe he's explained it wrong. But let me just kind of see if I can quickly clarify it. Imagine a ladder. Just like so. Okay. If you're going down the ladder, you want to be reducing your exposure. So you can have a maximum TP up there, you can have a stop down here, and you can have an order point there, just for argument's sake. Your game is to get here, right? Up, RF, risk free. In other words, you go to the first ladder point, you're out, goes up to there, take your profit. That's a simple way of doing things. All right. Market inevitably goes against you. So you can have 1, 2, 3 orders built up with all 3 running to here. Brilliant. Oh no, it's gone really bad. It's not looking good at all. In fact, it's a bit shit. Why? Because I know thyself. I'm panicking. So now what do? I've got 4 orders in, but it's actually reduced exposure on the way down. 4, you get out where you got in. You paid from that, and that one doesn't pay you at all. Oh no, goes down to the 5th one, 5, which is very close to the stop. It can be 5 or 10 pips to the stop. You really shit yourself. You get out here. Why? Because 5 pays off 1, 4 pays off 2. That is 0. That is a loss. And that is a loss. But you are break even. It's a different way of using the ladder. The ladder is so easy. You are just breaking up a trade into various chunks, and those chunks can then create an ROI, and your ROI will make you money. If you're going in on 3 and 1, no, you're always going to fail. Why? Because the odds are stacked in the market's favour. If you work on 1-on-1, go 50 points that way, 50 points that way, at least you've got an opportunity to operate the market. And don't worry about your stops. Worry about how much it's going to cost. Is it going to cost me £100? I'm comfortable with £100. Now spend that £100 effectively. If you're going to lose 10% of your account, make certain that you are really mentally capable of doing it. 10% of 1,000 is nothing. You put 10% into 100,000, 200 and beyond, then it starts becoming real figures. And that's what I'm driving at with all of this. But then just spend the money. Invest it. Right, okay, my stop's here. It's well out of the noise. Brilliant. Right. Now what do I want from it? Right. I might go to market 3 or 4 times. Brilliant. If I get 10% each time, there's an half rack up. And I might have a daily monetary figure. Might only want to make 30 quid a day. Brilliant. Just do it 3 times. 10, 10, 10. You know, you might even do it twice. 15, 15. Doesn't matter. Trading's about common sense, guys. It's not about arguments, not about I'm right, you're wrong. This one says that, the other one says the other. I don't give a shit. I really don't. I go into market every day with a common sense attitude. Put my levels in, get my direction, I know where my maximum pain threshold is, and then I see what I can get. That's it. That's trading in a nutshell. And for all those who don't like this sort of thing, fine. Don't matter. Carry on, and you'll have the same conversation in this time next year. Whereas I might have moved forward. You've watched my journey over the last 7 years doing this. You've seen me from a broken person right the way through to where I am today. Common sense. It's how we build businesses. Slag it off if you want. Praise it if you want. But do take these words to heart. Know thyself. If you're gambling, give in. If you're frightened of the markets, give in. If you don't know what you're doing, learn. And then once you've learned, apply common sense. So as always, guys, trade well, keep your risk managed, but above all, do what you love, and the money will follow. See you all in the next one.